The topics covered in Chapter 5, pages 59 through 524 from the textbook McGraw-Hill's Taxation of Business Entities of 2026. For the sake of congruency, I will be starting on page 58. For the executive summary, I will be reiterating the definition of book tax differences and why it's important to the companies, how this relates to the remaining topics: dividend ownership, stock ownership related, goodwill acquisition, corporate specific deductions with associated book tax differences, taxable income summary, corporate income tax liability, tax compliance, and we'll go over the conclusion. So like mentioned previously, a book tax difference is the difference between a company's financial accounting income and its taxable income. This discrepancy arises because the rules for preparing financial statements typically governed by GAAP differ from the rules used for calculating taxes, which are defined by the IRS tax code. Again, there are two main types of book tax differences. We have the temporary differences, which we talked about that earlier, permanent differences, and beyond that, the differences can also be categorized as favorable book tax differences, which is a difference that decreases taxable income, versus unfavorable book tax differences, which increases taxable income. Why this matters is that companies must track these differences and reconcile them annually. This process is critical for calculating a company's tax provision, which is an income tax expense that appears on its financial statements. It's also used to determine the necessary deferred tax assets and liabilities, which account for future tax consequences of temporary differences. Corporations that have stock ownership in other companies may receive dividends, and for book tax differences, the dividends received are included in their gross income, whereas for financial reporting purposes, how to allocate the dividends on the book is dependent upon the receiving corporation's level of stock ownership in the distributing corporation. The general rules of this is considered. So if the receiving shareholder corporation owns less than 20% of the stock of the distributing corporation, then the dividend received is included in both book and taxable income, and there's no book tax difference on the dividend. However, if the receiving shareholder company is holding the stock for trading and intends to sell it in a short period, then the shareholder corporation includes the unrealized gain or loss of that dividend income in their book income, but not in their taxable income, and that's considered a temporary book tax difference. Now, if the receiving shareholder corporation owns less than 20% of the stock of the distributing corporation, but no more than 50% of the stock of the distributing corporation, then the receiving corporation allocates a pro rata portion of the dividends on their books income under the equity method, which may create a temporary favorable or unfavorable book tax difference for what's reported on their books versus what's on their tax return. Now, when the company owns more than 50% of the distributing corporation stock, the financial books are usually consolidated for both companies. The intercompany dividend is eliminated, and the book tax difference may be too complex to consider the implication in these talking points. If a company receives stock from another corporation in a cash transaction, the tax basis is unchanged. For self-creating intangibles such as patents, they retain a tax basis of 0, although they're written up as for market value for book purposes, and any residual amount will be added to goodwill. Like mentioned in the previous chapters, the impairment testing allow companies to amortize their goodwill in the books for over 10 years. The book difference it doesn't arise until the goodwill is written off as impaired. So this book expense creates a permanent unfavorable difference. Alternatively, less frequent situations occur when a business may acquire the assets of another company's directly in a taxable transaction. The assets are assigned in a tax basis equal to the fair market value of any boot or excess paid over the fair market value, whether it is tangible or intangible, is allocated to tax goodwill and amortized over 15 years. This results in goodwill having both the book basis and the tax basis. There could be no difference on the book or taxes, or alternatively, it could cause a book tax difference due to the way that the purchase price is being computed. When the receiving company amortizes the goodwill for tax purposes, the book tax difference is a favorable one, as well as a temporary difference, and could get complex in nature. Now, if the company writes off the goodwill as impaired in a future period, the excess of book goodwill impaired over the remaining goodwill tax basis will result in an unfavorable temporary book tax difference. Well, so there are some examples in the book. For example, 5.5, it provides a good synopsis of this, and this is also a good example as well. Next, I'll be delving into corporate specific deductions with associated book tax differences, starting with stock options. Then we'll go on over to net capital losses, and then net operating losses. Beyond that, charitable contributions, dividend received deduction, and deduction limitations. When a corporation compensates their employees in the form of stock options, when it comes to tax purposes, tax treatment to the company and the employee depends on if the stock options are the less common incentive stock options or non-qualified stock options. Companies do not deduct a compensation expense from their taxes for incentive stock options. For non-qualified stock options, they are deducted for tax purposes. The bargain element, for which is the difference between the fair market value of the stock from the exercise price of the option, as a compensation expense in the year that the employee exercises a stock option. For book purposes, corporations are required to recognize the book expense for the stock options that they grant, having to estimate the fair value of the options on the grant date, expensing the value of the options as employee compensation over the employee's vesting period or service period of the time that the employee worked for the company. For ISOs, the book compensation expense is unfavorable, and it's also a permanent difference. NQOs can generate both a temporary and permanent book tax difference. The unfavorable book tax difference related to NQOs equal the value of the options vested during the year that are not exercised. The temporary unfavorable book tax difference reverses in the year that the employee exercises the option. Also for NQOs, the tax deduction will differ from the compensation expense deducted for book purposes. If the tax deduction exceeds the compensation deduction on the books, the corporation recognizes a favorable permanent book tax deduction in the amount of the excess. If the total book expense exceeds the tax deduction, then a company recognizes a permanent unfavorable book tax difference. So, here is an example to summarize what we've talked about so far as it relates to that. So now we're going to talk about net capital losses. As it relates to financial reporting purposes, if a corporation deducts net capital losses in the year that they are incurred, then it results in an unfavorable book tax difference and favorable book tax difference if the year that they use net capital loss carrybacks or carryovers to offset net capital gains. The book doesn't mention whether these differences are temporary or permanent. For companies that aren't consistently profitable for tax purposes, the tax law allows that they report deductions in excess of gross income in a particular year to carry over the excess deductions to reduce taxable income and taxes payable in years when gross income exceeds deductions. Referred to as net operating loss, they may be carried forward to deduct against positive future income in years to come. Net operating losses can only be deducted for the current year and not multiple years. If multiple occur, then they use the FIFO order for the deductions. Net operating losses can be carried back to previous years as well. So example 5.6 summarizes how this occurs. For financial reporting, corporations report losses in the year that they occur. This results in an unfavorable temporary book tax difference in the year that they generate. Corporations do not deduct NOL carryovers in their book income. So they end up reporting favorable temporary book tax differences in the year that they deduct the NOL carryovers for tax purposes. NOL carryovers are reported on line 12 of the IRS Schedule K form of Form 1120. Corporations are allowed to deduct charitable contributions to qualified charitable organizations. The limitation and timing rules differ for corporations regarding income-based deductions, allowing for them to deduct the monetary contributions, the fair market value of capital gains property they donate and the adjusted basis of ordinary income property. For book purposes, corporations can deduct charitable contributions in a year before they pay the contribution within 3.5 months of their tax year, or 2.5 months within a June 30th year-end close date, and if their board of directors approve the payment. A corporation's tax deduction is limited to 10% of their charitable contribution limit. Modified taxable income, which is defined as taxable income before any deductions, any charitable contributions, the dividend received deductions, net capital loss carrybacks. NOL carryovers are deductible to find out the charitable contribution limited modified taxable income, but the net capital loss carryovers are not deductible due to them being unknown when figuring out the limitation. So there's more rules applying that are applicable in determining the deduction. Please see example 512 in the book for a further explanation of this. Now, corporations report unfavorable temporary book tax differences to the extent the modified taxable income limitation restricts the amount of their charitable contribution tax deduction, which is the amount of charitable contribution carryover they generate for the year. Alternatively, they will report favorable temporary book tax differences when they deduct the carryover for tax purposes and not book purposes. Companies that receive dividends have those dividends included in their taxable income at 21%, but for tax purposes, they can take a dividend received deduction, which reduces the taxes paid on these dividends. This helps corporations reduce the third level of taxation that we talked about in Chapter 4. And especially if there's a need to distribute their earnings as dividends to their own shareholders. The DRD reduces the second level of taxation. Now, this is done by multiplying the dividend amount by 50, 60, or 100%. The multiplier is dependent upon the level of stock ownership by the recipient corporation, for which this corporation must be a domestic one. There is also an example in the book to support this. This deduction is limited to the product of the dividend received deduction percentage, and the corporation's modified taxable income is a dividend receiving corporate taxable income before the deduction, DRD. Net operating loss deduction and net capital loss carrybacks. Please look at example 517 if you would like to get more understanding about this. The limitation does not apply if after deducting the full dividends received deduction results in a current year net operating loss, and the corporation is allowed dividends received deduction regardless of the modified taxable income limitation. The dividend received deduction is a tax deduction that is not a book deduction. Hence, it creates a favorable permanent book tax difference. Corporations will probably use a template in their software system that allows for them to reconcile their book and taxable income. The book shows a template using Exhibit 5.8, which doesn't follow an accounting format, but is organized in a manner in which it would be easy to garner the taxable income computation, putting the deductions in the sequence that they are deducted for taxation purposes. As mentioned previously, before corporations do use a flat 21% tax rate to compute their pre-credit federal income tax liability to their taxable income. Now, some corporations may be subject to the alternative minimum tax. So with the AMT provisions, a corporation's tax liability is greater of the regular tax liability, or 15% of the company's adjusted financial statement income for that tax year. AMT applies to corporations with an average annual adjusted financial statement income over $1 billion for the previous 3 tax years. As shown here on Exhibit 5.9 and 5.10, taxable income for corporations is reported on Form 1120. This form includes a schedule for corporations to report their tax book differences on Schedule M1. One of the biggest eye-openers for me from this lecture is that book taxes and income tax aren't the same thing for taxation purposes. So, companies often report different income numbers on their financial statements versus what they actually pay for taxes. And I thought that it was all conclusive with book income. So when it comes down to donations, companies just can't write off anything that they want. They have that charitable contribution income limitation, and it's like so many rules associated with that, rules on top of rules. And with the taxable income versus big income, it's not a one-step math problem. So reconciling taxable income and book income isn't as simple as just subtracting expenses. It's a whole template that companies use that I wasn't even aware of. All right, and this concludes my presentation. Thank you all, and here are some sources for you to enjoy.